Hello and welcome. You're seeing pressure in markets, and what we've therefore tried to do on Know Your Company today is something which is more inward facing, more looking at India and the possible growth with regard to power, because that may not change significantly, even though there are risks, but may not change significantly due to tariffs. And therefore we're looking at a Nifty 50 company, Power Grid Corporation, and we're going to quickly try to break this one down. Power Grid, what does it do? It's India's largest electric power transmission company. It has a 70+% market share in power transmission. And what is power transmission? I'll probably try to break that one down as well. One is the power generation, which say happens in a particular place. Thereafter, the power consumption is happening in quite another place, whether that's a manufacturing facility on the outskirts of a particular city or a metro, or it's within a city where you and me consume power, right? So therefore, transporting that power over grid lines from the place in which it is generated to the place in which it is utilized is essentially what Power Grid does. And there are various places along the way where power transmission will happen and go through these power grid lines, thereafter landing up with the final consumer. So that's what Power Grid Corporation does. What they also have is they command an 80+% of grid capacity of India. So the entire grid capacity, 80% of that is run by Power Grid, and then 20% are by some of the smaller players. In fact, less than 20%, 84% absolutely precisely is the power grid capacity that Power Grid has. And therefore, this is a large chunk of India in terms of coverage as well as in terms of grid lines, and therefore very difficult to get power from one place to another without involving a company like Power Grid. That's essentially what I'm trying to underline. 70% of India's power goes through the Power Grid Corporation grid, and 84% of India's interstate lines are run by Power Grid. Now, in terms of the capex plans, because grid capacity needs continuous expansion as well as needs upgradation. So you have 23,000 crore of capex in FY25, and this is important and relevant, and we'll come to why it is important and relevant as well. But for the moment, this is the kind of capex plan that's being put up. FY26, there is a 28,000 crore capex plan, and FY27, there's a 35,000 crore capex plan. Combined, the capex plan is closer to 90,000 crore. And we're talking about a company with a sub 3 lakh crore market cap doing a 90,000 crore capex over the next 3 years. This is why it becomes extremely relevant to know this particular metric. Now, in terms of funding its capex, it does it in two fashion. Of course, internal cash flows and resources is what it uses to push capex out, but also debt financing in a big fashion. And debt financing, you will see in terms of the balance sheet debt, is sizable in that sense. So something you may want to keep in mind, because these are large capex plans, right? Now, in terms of how it runs its business, the returns for Power Grid are regulated, because you have there's a framework that is in place, and regulatory authorities determine the rate at which power transport or transmission actually happens. This is largely done on the basis of a cost structure which they keep in mind. They also consider debt, and they look at the debt raise, and they consider the ROE, the final ROE to Power Grid, which in some form or shape they try to cap. So based on the texture of the market as well as the industry, they look at anything between 14.5% to 15.5% in terms of ROEs when they determine tariffs, and thereafter they lease these lines, and a tariff is actually paid out to Power Grid. So they follow this framework to ensure that Power Grid earns fair returns, and at the same time there's no cost burden or disproportionate cost burden saddled on the final consumer. So that kind of blend is what regulators keep in mind when they determine tariffs. Now, that's essentially how the business is run and the structure works. We have spoken with Rupesh Sankhe of Elara Capital, who tracks cap goods and power. And he's given us his views with regard to power grid in particular, and we've discussed some risks with him, which we will, or rather we'll speak with him and we'll highlight some of those risks to you, and we'll try and ask him and quiz him on some of the risks. But let's quickly talk about the metrics that we need to look for in terms of a company like Power Grid. First off, we'll look at the income statement, how well that is growing and how that has done over the last 3 to 4 years. We'll look at the balance sheet. This will be key because large capex plans, mind you, just want a quick refresh that as well. The order backlog, how large in terms of orders and capex is like, and how much is the work in hand, and what is the execution looking like. In terms of cash flows then, how does cash flow stack up? We'll also look at how return ratios are playing out. We're looking at shareholding, and we'll look at street cred and street coverage, and thereafter derive a rating. So over the next maybe 10 minutes, we'll try to break this down. Mihika Barve joining me for this one. Mihika, it's been a while since we had you on KYC. But why don't you help us with the income statement?
Yeah. Let's start off with the income statements. Now, in terms of your 9-month FY25 numbers, your revenue stood around 33,000 crores, EBITDA around 28,800 odd crores, margins stand at 86.1%, and net profit stands around 11,300 crores. Now, in the 9 months FY25, and the kind of growth you've seen on a year-on-year basis, we have seen a slight degrowth. Revenue is down 1%, EBITDA down 3%, margins have come off by 190 basis points, and net profit has remained flat, biased to the negative side. However, it's key to note that the company, the way it recognizes revenues is how much of its order backlog it's recognizing and how much of its capex it's capitalizing. So we could see more of the capitalization done in Q4. But when you look at the 3-year CAGR, it's done pretty well. Revenue and EBITDA, 5 to 6% of CAGR. We've seen margins grow almost 500 basis points, 460 basis points of growth, and net profit has seen almost a 14% CAGR. And because of the kind of growth it's seen on a long-term period, we've given it a neutral rating, and it's key to note that Power Grid is a regulated entity, and that's why its returns are usually capped because of the kind of bidding process it goes through when it's getting a certain order. So Harsh, how does the balance sheet look though?
Yeah, I want to quickly also highlight that those return ratios are capped, and therefore you might not see the kind of growth that you're seeing till significant capex is done. Once significant capex is done, it starts to work out. Also, the real-time market, which was RTM as part of our graphics, is also one of the factors that takes care of the return ratio as well. So something that we'll want to keep in mind. But quickly on to the balance sheet. The balance sheet, let me just pull out the total equities, which is around 92,000 crore. It's trading at nearly 3 times price to book at this point. Cash and cash equivalents, not a surprise that it's something a shade lower than 4,000 crore, not a surprise because it's got large free cash flow coming in quarter after quarter. The total debt is 1.23 lakh crore at this point, and the financing cost annualized is roughly 9,000 crore. So your interest burden is around 9,000 crore annualized on a debt burden of 1.23 lakh crore, which goes on to show that your interest expense is not very high, or rather your interest rate on debt is not very high, because this is largely a government-backed company, and therefore it enjoys sovereign rating, and it enjoys its debt enjoys the sovereign related debt cost. So therefore you're largely seeing that debt cost is not very, very expensive for this company, despite it having a very, very large debt. So when you're looking at debt to equity, debt exceeds equity. But at the same time, we've given this a neutral because one, it's sovereign backed, interest cost is not very high. And when you're looking at its EBITDA is roughly 30,000 crore. It does a PAT of roughly 17 to 18,000 crore, which is 2x of the interest cost. So it covers interest cost by at least 3 to 4 times if you consider the EBITDA number. And therefore, there is that margin of comfort in terms of it being able to service interest cost. The other piece is that it does service its debt as well on a recurring basis. also based on the depreciation it claims, and it's a large component. It claims around 12 to 13,000 crore of depreciation every single year. And that helps the free cash flow to continue to pour in because it's a non-cash expense essentially. And that helps also to some extent to service debt, and therefore are neutral on the balance sheet. But Mika, on the order.
Yeah, the order backlog or work in hand is how PowerGrid puts it. It's looking really good. They have, as of Q3 FY25, it stands at 1.43 lakh crore. On a quarter-on-quarter basis, there's no growth. But if you compare it to the first half of FY25, which is your Q2 FY25 number, you've seen a 26% growth in the work in hand. Even if you look at how it looked in Q3 of FY24, it stood at 77,000, and that marks an 85% growth in the work in hand for PowerGrid. The work in hand, in terms of 65% of the order backlog or work in hand is currently from new tariff-based competitive bidding projects. Now, this is something where, companies bid at the lowest tariff that they can put up the project and win. So PowerGrid is even winning this, the projects in this process method where competition tends to be high. And 27 of their order book are from new interstate transmission systems. From the work in hand and the kind of revenue visibility it provides for the company, it's looking a thumbs up on this one, Harsh.
Interesting. Let's talk therefore about how the return ratios are stacking up on this one, Mika. You're seeing anything between 18 to 23% in terms of ROE number over the last 3 years. The ROA number also very, very healthy at around 6 to 7%. The ROC number may be lower, but mind you, this also has a very, very low debt payout, and therefore the debt earning on this would be maybe 7% odd, which kind of caps ROCE. But ROE is very, very healthy in that sense. And that's the real number that shareholders should essentially look for in a company like this, the ROE number. For a PSU company to be at 18 to 23% ROE and having that sustainable, having that firing sustainably for itself is obviously impressive, and therefore it's a good number. Thumbs up on that one.
Yeah, and Harsh, before, what about cash flows? How are cash flows looking like? Because you've seen them kind of turn negative in FY24, but it all depends on their capex cycle as well.
Yeah, correct. Absolutely. So cash flow will always be healthy on this one, Mihika, because as you well know, your profit after tax number is around 16 to 17,000 crore. They have around 12,000 crore of depreciation, which they book nearly every year, and that is also a sustainable number because the capital cost is continuously going up, and therefore you have a healthy cash flow. Why the net cash flow is negative? Because they continue to invest very, very heavily in their infrastructure. What they also do is they have a very healthy dividend payout. In fact, till maybe a year or two back, the dividend payout was nearly 6%. Of course, the stock has gone higher after that.
It actually increased in FY24.
Correct. So it was nearly 6% at that time, and therefore it has very, very high dividends or a very high dividend payout, which is why you're seeing the net cash flow being negative. But otherwise, there is a fairly healthy clip on which the operating cash flow is growing at. If you look at that operating cash flow metric again, there you go. The growth is fairly healthy on this count. So neutral on the overall context of things, but it's a healthy number where
we do see moderation in cash flows, especially when it comes to something like a PowerGrid.
Yeah, and one thing you may want to keep in mind where cash flows is concerned is how the execution with regard to capex happens. If that were to happen, you'll see this shoot up, and which is what I'll be looking for actually, and that's one of the reasons we've given this a neutral. Mika.
Yeah, let's go up to your shareholding.
Yeah.
Next, you've seen strong promoter and promoter group holding. It stands at 51%, even if you compare December 2024 to March 2022.
This is government.
Yeah, this is government.
Sorry.
It's fully government.
Kind of,
So when you talk about DIIs, as of March 2022, you had strong domestic ownership, but your foreign ownership stood low, but you've seen a clear growth. There is still some strong domestic institutional holding at 17%, FIIs at 28%, and you also have some retail participation at 3.5%. So from a shareholding pattern picture, it's a thumbs up on this one. And then let's move off to Street Cred. Year to date, the stock is down 6.4%, but there are a lot of other factors that are also coming into consideration. But even if you look at a broader timeline of 1 year, it's not done much. It's 3.2%, which you've seen other power transmission companies do better than that. And in the 5-year period, you've seen growth 214%. And Power Grid has always been talked about. You have longer term projects, so it's going to take longer term to get returns. So we've given a neutral in the street cred because you have seen year-to-date and 1-year performance not do as well.
Yeah, and it's a 3-bagger otherwise.
Yeah.
So your 5-year performance has been fairly healthy. You'll want to wait for execution on this one. Let's look at street coverage very quickly. 17 buy calls, 1 hold call, and 6 sell calls. Overall, you have an upside potential of roughly 12%. Quickly sum it up: income statement neutral, balance sheet neutral, order backlog positive, cash flow neutral. You're seeing return ratios a healthy thumbs up, shareholding a thumbs up, street cred a neutral, and street coverage a thumbs up, and therefore gives it a 6 out of 8 on our KYC ratings. But let's quickly go across. We have our guest to talk to us about Power Grid. We have Rupesh Sankhe, Vice President of Research at Elara Capital, tracks both power as well as cap goods. Welcome, Rupesh. Good morning. Good chatting. First off, I want to understand power demand. And because there's just so much happening around tariffs, I want to understand what the impact could be on something like a Power Grid, especially on the industrial and commercial demand side of things. What is your view on this entire play which is happening in global markets, and what is the impact likely on something like a Power Grid?
We don't see a major impact in terms of power demand is concerned, because in the last years, we have seen the power demand to GDP growth has close to 1.1 times. Historically, the same ratio was around 0.8, 0.9. So we have seen a lot of traction there on the residential side. So residential is close to 25% of the overall power consumption. And in the last decade, we have seen that segment where the demand was slightly slow. But that demand is now catching up. I think the load shedding has gone out completely. So that demand is there. And in terms of the manufacturing or the commercial demand, industrial and commercial demand, we don't see that much impact on the power system demand, because it's largely driven by the domestic production. No doubt, I think there is a market. People are saying that GDP impact will be around 40-60 basis points because of a global trade war, but that will not have major impact as far as the power demand is concerned.
Point taken. Understood.
Investment theme on the green transition is there for next 10 to 12 years.
Okay, so yeah, got it. Understood. Point taken. And how should one view the business sir, in terms of return ratios? They're capped. There's a large transmission requirement, of course, that's there. But how do you view the business with capped return ratios?
Yeah, definitely. See, if you look at the last capex phase, high growth capex phase, was during 2012 to 2018. That time, we have seen the power transmission capex in India has grown significantly because of integration of all the grids. So Power Grid that time doing close to 35,000 crore kind of a capex capitalization. And in the last 3-4 years, we have seen the same capitalization growth has come down to around 15,000, 17,000 crore. Now, because of this renewable energy integration, then green corridor phase, I think again the next 3-4 years we'll see around 30,000 crore kind of annual capex for Power Grid Corporation. Now the Power Grid has 1.4 trillion of work in hand. That is based on FY27, the transmission opportunities. From 27 to 32, close to 4.9 trillion capex opportunities there. And out of that, close to 3 lakhs is for interstate, where Power Grid has significant market share. Almost 55% market share is there. So if they maintain the similar kind of market share, another we can see around 1.5 trillion kind of work in hand opportunity. So close to 3 lakh crore kind of opportunities there for next 10 years. So on a today's regulated equity, because this is largely TBCB projects, so their ROE will be, as you are rightly pointed out, ROE is slightly lower than the regulated ROE, but the overall equity base will double in the next 10 years. So that is close to 7.58% kind of growth in the equity that we can see. So that kind of opportunity is there. So we are overall positive on the transmission space, because without that integration of 500 gigawatt capacity, or maybe upcoming green hydrogen data center, that is going to be challenging. So this kind of capex has to be there to meet a 400 gigawatt kind of a peak demand by 2032 that we are expecting.
And Rupesh, what should one make of competition? Of course, tailwinds are strong, but how is competition shaping up for a power grid? Can it maintain its monopoly?
So definitely, the power grid has a strong execution capability in the transmission space. So they have that technical capabilities in place. Secondly, if you look at their balance sheet, every year they are generating close to 17, 18,000 crore kind of profits. So that cash flow is there. Okay. Third, in terms of cost of debt, they are better as compared to other players. So managing better capital allocation, better capital structure, and execution capabilities they have, because a lot of issues are there in terms of right of way, land acquisition. There they are better as compared to other players, and that is what we have seen in the last 3 years when they started entering into TBCB projects. Earlier, their market share was hardly 15-20%. That has gone to 60-70%. That kind of capabilities they have. So execution, the technical capabilities they have, the financial leverage they have in terms of managing cost of debt, I think they are ahead as compared to other peer companies. So they are well placed in terms of to grab this opportunity.
And Rupesh, how should one look at cash flow? How much capex are you building in, and how is that expected to be funded? Just give us the way in which cash flow will go about.
Yeah, it's a good point. See, this year we are expecting close to 18,000 crore kind of a capex. Next year, it will be around 30,000 crore capex. Even next 3 years, we can say a run rate around 30,000 crore kind of a capex. Now, in terms of capitalization, because it takes 3-4 years, 3 years to get commission. So capitalization will be slightly lower than the capex. So it will be around 20,000 crore. But if you look at their equity contribution will be in the range of 75-25, or they might go 80-20 kind of a debt equity ratio. So if you look at the after dividend, they will have significant cash flow for the equity contribution. So we don't see any risk there. Now, in terms of a dividend, we are expecting they will maintain around 8 to 9 rupees per share kind of a dividend. That comes to around 3% at the current market price. So we don't see that risk because of a huge capex there that will have, because they have got a strong cash flow in hand. So they will maintain the current dividend payout ratio. At the same time, they will have sufficient equity for their under construction projects and upcoming projects.
Okay, and your view, what's the largest risk factor to be kept in mind here from an investor perspective?
The risk factor only in case of high penetration of battery storage, because batteries will get installed in the existing transmission assets. So they might not have to go for incurring extra transmission assets. So that is a risk, but we don't see that this is a near-term risk for the battery to get deployed in such a high pace as of now. Second is delays in getting right-of-way issues or land acquisition, or any delays on the renewable energy, because largely capex is coming for the integration of renewable energy with the main grid. So that will have some risk in terms of delay in RE tendering.
Right, Rupesh. And Rupesh, how should you value this? Contextualize the valuation for us. Not easy to value.
Yeah. So definitely, if you look at their valuation band in the last 15 years, they get premium when the capex capitalization trend is on the positive side. So during 2007, 2011, 12, when mostly generation capex was there, that time this transmission were getting slightly lower multiple. From 2012 to 2018, the multiple has gone up significantly. Now we are also seeing the similar kind of high capex growth in the next 10-12 years. So definitely they will get a better multiple. So logically, if you look at the returns they are getting from the regulated assets and their TBCB projects, like slightly close to 15-16% ROE is there. and your debt is fixed over a period of 10, 12 years. So you have steady cash flows there, and return is there, and you also have a growth associated there. So normally it's better to value based on price to book value, considering the cost of equity, the growth which is there, and the ROEs they are generating from these assets. So best valuation tool for power grid with steady cash flows, one-time capex, and you get the revenue for next 25, 30 years. Best way to value them is based on price to book value.
Point taken. And what's the multiple you ascribe to this, Rupesh? What's the upside?
See, we have positive view on the stock. Upside from the current level is close to 25%. We have given a price to book value multiple at around 2.8x based on FY27, the regulated equity and overall equity they will get from the TBC. So now the regulated equity as of now is close to 92,000 crores. And based on the 1 lakh crore kind of capitalization they are doing in the next 3 years, we can see around 30,000 crore kind of addition in their existing regulated equity. Over that, we are giving 2.8 times market cap to equity, considering they will maintain 15.5% kind of ROE on a consolidated basis, and the growth will be around earning growth will be around 9.5%, and capex growth is they will maintain 55% kind of a market share in the upcoming transmission opportunity from 27 to 32. So that way we have arrived at value of around 350 rupees currently. Our fair value is 355.
Okay, point taken. Thank you so much, Rupesh, for coming in and speaking with us with regard to this one. It's a well-tracked counter, and it's a Nifty 50 stock, so wide interest in that sense, and also slightly insulated from tariffs. Interesting one, but hope this has been helpful. From Mihika, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.